Hi, everyone. I wanted to touch base again with our Chief Investment Strategist, Philip Petursson. We've had many conversations with Philip, and Philip, I got to say, you've also become a wonderful friend. And I can't say how much I value the input that you always have, and also the foresight that you bring. You're a regular on the Business News Network, BNN, and I know many other features as well. But to have this one-on-one with you and to relay some of the comments from our clients and to hear back from you, I think that's tremendous value. So thank you. Thank you for joining me today.
Hey, Rod, thank you for having me. It's a great pleasure to speak to you and everyone else. As we can do this, I'm very, very happy to join.
Yeah, appreciate that. So, there's a few things I really wanted to touch base on. One of them, of course, is I think everybody's breathing a bit of a sigh of relief because, the first quarter numbers came in and they were positive. And so that in itself, of course, makes people feel good. But, that isn't the whole story. Maybe could you touch base a little bit on, how did you feel? Were you a little bit surprised maybe by the outcome of the first quarter? Really to talk
Certainly.
about. Yeah.
Yeah, absolutely. And I think reflecting back on where we were, say, 6 months ago, as we started to put together our outlook for 2023, we were a little bit more modest in our return expectations. We did see better opportunities within certain areas of the world than others. But we would say largely we came in with an expectation of a positive year, but more likely one that's going to be characterized by below average returns. And so in the US, that we felt we would be in the low single digits. Canada, we felt we'd do a little bit better, and Europe and emerging markets better than that. And the relative returns have largely played out that way. International has been the best performing area out of the broad markets. Canada's done okay, but the US came out a lot stronger than we thought. At the end of the first quarter, the S&P 500 was up 7%. Canada was up just shy of 4%. And then you have Europe up about 11%. And the emerging markets up, I think it was about 8% or so.
Yeah.
And so we did have a very, very strong first quarter. And again, it surpassed our expectations, which we'll take. I encourage positive markets, but it did come as a bit of a surprise.
Yeah, of course, what everybody wants to do is they want to, put the stop button on that, of course, and hold that gain for the year. But we know that markets are always fluctuating at any time. But, there's something that we've talked about as a theme over the last 6 months. And certainly, as the economies are going back to a normal position, a normal growth rate, right? And, I talk a lot about that with our clients, that this isn't a slowdown because of economic instances. This is actually a controlled slowdown back to a normal pace where demand equals supply, where there are people looking for jobs and you have a choice, right? So not rapidly high unemployment. But when we go through these kind of cycles, again, with markets being somewhat unpredictable, the news, in my opinion, is only now going to start to get worse, right? Can you talk a little bit about that, about the lag from interest rate increases to when you actually see it in the news and what it really means from portfolio management?
Certainly. We talk about it from the economic perspective, where the true impact of interest rate increases aren't felt in the economy for 6 to 12 to potentially 18 months after those increases have taken place. Now, in Canada, we see it almost immediately with respect to variable rate mortgages or lines of credit that adjust their rate when the Bank of Canada adjusts its rate. So that's a little bit more immediate. But when you get kind of the trickle down effect, and think of it in terms of individuals that are renewing their mortgage, not everyone is subject to a variable rate mortgage. In fact, it's only about 30% of the mortgage market out there. So another 70% of borrowers will eventually renew their mortgage, part last year, part this year, part in the next, say 5 years, if you have a normal distribution of these. And so the impact of the interest rate increases can be delayed for some people, but it's coming nonetheless. And we're seeing that. And we've heard more and more of that in terms of inflation. Well, here's the interesting thing on inflation. The spikes in inflation are behind us. And in fact, we would argue one of the ways that we measure inflation in Canada would suggest that inflation now is running at a pace that's in the 2 to 3% range. Even though the official number is still 4, that's on a year-over-year basis. But if we look shorter term, now inflation is almost back to normal. Rates are a little bit higher than normal, but inflation is where the Bank of Canada would want it. And we think it's going to trend in that 2 to 3% range through the remainder of this year even though the year-over-year number might show a little bit higher, the actual inflation that we're seeing on an annualized basis is lower.
Interesting. Yeah, thank you. So from a client's perspective, of course, they're long-term investors. But here's what's interesting. As long-term investors, and we see these numbers in the industry all the time, is that when markets go down, after they've gone down, people move to cash. Or if they have cash, they choose not to invest because they're nervous. It might go down further. Yet the whole fundamental basis, of course, of investing is always buy low. Unfortunately, nobody knows what hour that is. So for people that are sitting on cash today, we've talked a lot about the fundamentals of the fixed income market, bonds in particular. And really what's happened over the last 6 months when we first started talking about that. I don't think that this is a one-time deal. I don't think that that's over, but I'd let you to talk a little bit about the fixed income market.
Yeah, certainly. And I want to do this in two stages. One, you're absolutely right that people tend to go to cash at the wrong time. And I've seen this throughout my career. I've been tracking this data. I've got data going back to the 90s now. And every time you see the markets, the equity markets in a downturn, that seems to be the trigger point for investors selling stocks and moving to cash. And it's almost perfectly correlated, being the selling pressure comes at the exact wrong time or right at the bottom of the market. And I don't allocate towards cash. As a portfolio manager, I just stick to equities and fixed income because I think that is the better alternative trade. When we talk about bonds, we look back to 2022, and they had a very challenging year. We call it the 1 in 100-year flood for bonds, in that interest rates were at zero to start the year, and then very rapidly the Bank of Canada raised rates and to 4.5% where we are today. And when you go from 0 to 4.5, that is when you see significant negative returns out of bonds. And again, we've never had that in our history of 0% interest rates very, very quickly in a 12-month time frame going to 4.5. But where are we going from here, right? And this is what we have to think differently about bonds than other asset classes, is that you hit the reset button almost every single year. And so is there a probability that we can see a negative return like we had last year in bonds? Highly unlikely, because the direction for interest rates over the course of the next 12 to 24 months is lower, not higher, meaning we're already seeing inflation come down. I just mentioned it. The Bank of Canada has paused in their rate increases. While they've said they're willing or they're keeping the door open to further rate increases, they're not going to do that. In my view, in our work, they're done. And they can take pride in the fact that inflation's heading lower. So what that means for bondholders is that, one, you're getting an attractive return if nothing else happens. And we're seeing returns on or yields on bonds, the interest rate equivalent, if you want to think of it that way, in the range of 3% to 8% for high yield bonds. So somewhere in the mid-single digits. Now here's, Rod, where it works to investors' benefits. If you are fearful, if you are worried about the environment, then bonds provide not only defense from just the return profile that they offer today, but if we truly believe that we were headed into some type of deep recession, what's the Bank of Canada going to do? They're going to cut interest rates to support the economy. As interest rates fall, the value of the bonds go up. So it's no longer, say, a 4% return. Now it's higher than that. That's upside potential to offset some of the risk that we could see in the equity market. So when we talk about what we came through last year and why we want to own bonds this year, it's because they have returned to that more defensive characteristic in our portfolios that in the worst case scenario, they're actually going to make us money.
Yeah, it's funny you say that, because last year, if you were a more conservative investor, it was one of the worst experiences, as you said, right? For sure, in most people's careers, I would argue, right? Because of that fixed income component, again, unusual, unknown, a 1 in 100 event. It's an interesting analogy, or I think you called it a flood, right? But we'll call it an event. But, I was, as I mentioned to you a bit earlier, and I've been talking with clients, I said, I really truly believe that this is the year of the return of the balanced investor. For the balanced portfolio, I think that people are going to be very pleasantly surprised, as long, again, all things being normal, but based upon the things that you've said, being a conservative investor is probably a very good thing at the moment because of the opportunity in the fixed income market.
Yeah, absolutely. I agree 100%. And that's because we're seeing interest rates at levels that we haven't had in many decades. And then again, it's all, where are we going from here? Well, if the impetus for the increases of interest rates in Canada and the United States and around the world was to fight inflation, and we're seeing inflation now month over month come down, well, interest rates will follow. And as interest rates fall again, the value of bonds move higher, and so we're generating an attractive return right now, and we're going to likely generate a better return as we go forward. So yes, you're exactly right. The 60-40 portfolio, or whatever that balance is
Yeah.
for investors, we should be right back there. In fact, in some of the portfolios that I manage, we have skewed a little bit more towards bonds because of that downside protection, with a very attractive yield along the way. So it's the old adage of you're getting paid to wait. Yeah. So if nothing else happens, I'm generating an attractive return that we think is going to be similar to equities. And if things get better, well, that's fine. I'm still going to make money on my bonds. If things get worse, I'm going to make more money on my bonds. So yes, balanced approach to asset allocation, is exactly where we want to be. Very different. With there's a little bit more to the analogy, is that we came from the drought. The drought was when interest rates were at zero and you're really not making any coupon on your bonds, to the flash flood where now interest rates are much higher. So it didn't make a lot of, it wasn't very advantageous to own an overweight to bonds, or even a neutral weight to bonds when interest rates were at zero, because there was only one direction for them to go, higher.
Correct.
But now, it's a completely different story. It's a completely different environment for fixed income, one that works to the benefit of investors.
Well, you know what, Phil, those are going to be really happy words for anybody that's watching this in our client base, because about 80% of our client base is going to fall in that balance category, right? Where they have a blend, of course, equities and fixed income. And that's very positive news. So, okay, so let's put you on the spot. Okay, a few questions, right? So, Europe, you mentioned, has been one of the top performers. Is that a trend that you continue to see?
Yes, Europe is in a different economic cycle than what we see in the United States. All the talk a year ago that Europe was going to fall into a bad recession because of the war in Ukraine and the secondary effects of that. Energy shortage didn't happen, food shortage didn't happen. So Europe actually is doing quite well. They're probably going to outgrow the United States in terms of economic activity because of the China reopening. And the reason, the link there, is that Europe has greater trade ties with China than the US does. And then Europe also benefits from very attractive valuations in the equity markets, and earnings growth that we think is going to be superior to what we see in the United States. So we're just at the start, we think, of this European renaissance, if you will, of outperformance relative to the US that we think can continue at least over the next 12 months, but this could be a longer term theme.
Yeah, it's interesting because whenever I mention this to clients, of course, they always say, isn't Europe a mess? And I say, well, politically, maybe socially, there's many reasons that they may be a mess. But economically, ironically, like you say, it's a start of what we really see as a strong economic growth period. And that's when we want to be there. Really interesting. And as well, Phil, but I don't want to hold you too long. But so what else can you tell me that I think our clients go, oh, here's one for you. Tell me what you think about the Canadian dollar.
Great question. And here, every time that we talk about the Canadian dollar, we have to think about two things. One, the direction for oil, and two, the direction for interest rates against the US. So where the Bank of Canada sits with the Federal Reserve. First, on oil, a few weeks back, OPEC plus Russia decided to cut production to the tune of about 1.65 million barrels a day. Now, Rod, they do this with a wink and a nudge. Yeah. We're not going to get a cuts of 1.65 million barrels, but it's more the commitment that OPEC has to maintaining the price of oil with respect to a weaker economic outlook through the remainder of 2023. So with that in mind, all producers benefit when oil prices are up, including Canadian producers. And how that relates to the loonie is that oil and oil products are one of our largest exports, done in US dollars. So when oil prices are high and strong, the Canadian dollar tends to appreciate. Right now, that would suggest that we see upside pressure to the Canadian dollar against the US. So we're trading at about 74 cents today. We think that we can get to about 76 over the next 6 to 12 months, and the risk is to the upside, not to the down.
Oh, great. Yeah. So that means we're going to pay more for fuel this summer.
Yes, we will.
Yeah, that's a given. Yeah.
That's just a flat out given.
Yeah, those of us in Kelowna know this. Yeah, this is the way it works. Philip, I don't want to hold you too long. I know that you're a busy fellow, and I know that I appreciate how much time you take with this. And if you don't mind, we'll keep doing this quarterly, and we'll send this out to our clients. It's one. I get great feedback from it, and look forward to seeing you again in our fine town. Okay? Thank you.
Yeah, looking forward to it, Rod. Thank you very much.
Okay, take care.